Now let's focus on Egypt. It's making headlines thanks to its crumbling economy. Yesterday was a big day for them. Egypt was promised a big loan, $8 billion. By whom? The IMF, the International Monetary Fund. Earlier, they were promised $3 billion. So this is a major jump, an increase of $5 billion. But when it comes to the IMF, there's always a catch. Conditions always apply. And this case was no different. Egypt had to do something in return for the extra $5 billion. It had to stop artificially supporting its currency. That's the Egyptian pound, their currency. Cairo let go of its control over the Egyptian pound, and in exchange, the IMF agreed to give it a bigger loan. As you can imagine, Egypt's currency took a tumble. Its value fell by about 2/3. It went from about 30 Egyptian pounds to the US dollar to around 50 pounds per dollar. The crash has alarmed the people of Egypt.
Changing the foreign currency rates affects us in every way. Once the merchants knew the rate has changed, the prices rose immediately.
Is everything in our life linked to the USD? All our problems are now attributed to the USD. What about other goods that we should buy with Egyptian pound? What happened to the Egyptian pound? It is worthless now.
Despite these dire reactions, the Egyptian government is hailing this as a victory.
Thank God today we signed the agreement between Egypt and the IMF. I want to reiterate that the deal comes in line with policies of structural reforms for the Egyptian economy prepared by the Egyptian government.
We're at the beginning of the right course for the country to be economically balanced and strong, with the efforts of everyone and the understanding of everyone.
Egypt's Prime Minister and Central Bank Governor both seem happy. They're pitching this as a great reform, despite what it could mean for imports. Let me explain. Egypt depends on imports to survive. For example, it is the world's largest importer of wheat. It needs to bring in about 12 million tons of wheat every year to feed its population of 110 million people. Now, imports are expensive, and they're paid for in US dollars. So Egypt needs foreign currency at reasonable rates. That's why it had pegged the Egyptian pound. It helped rates keep them steady at about 30 pounds to a dollar for almost a year. This should have kept prices stable. But that's not what happened. Egypt's inflation was officially at around 30% in January. So clearly, keeping the currency rate fixed was not working for them. And this is because people were ignoring the official rate. There is a black market dollar rate in Egypt. Foreign currency was hard to get at the official prices, so traders bought this currency in the black market and passed on the difference to the customers. This is partly responsible for the high prices in the country. Foreign currency at official prices was hard to come by for a number of reasons. Tourism was down. Fewer ships were passing through the Suez Canal. Expensive imports means dollars are spent there. And all this meant that Egypt's government did not have dollars to spare. People could not buy them at the official rate. They had to buy dollars in the black market, and this culminated into Egypt's present crisis. So now Cairo has decided to stop controlling the pound. This will help the official and black market rates converge, and they hope prices will go down as a result of this. Egypt's central bank has also increased interest rates by 600 basis points or 6%. They hope this might also help curb inflation.
Regarding the Monetary Policy Committee's decision to increase interest rates by 600 basis points during the extraordinary meeting today, the aim is containing the inflation rate and speeding its decrease to approach a single digit in the medium term.
Single-digit inflation is an ambitious goal, but Egypt has given itself a system shock. It will take some time to see the results, but hopefully it's a step in the right direction.